So, you just bought a new home. First of all, huge congratulations. That is a massive deal. But right after the excitement wears off, this big question hits you. What's the smartest way to protect this huge investment for your family? Today, we're going to break down a choice that gets thrown at you in a really confusing way: mortgage insurance versus life insurance. I mean, you can just picture it, right? You're at the closing table, the excitement is through the roof, but so is the literal mountain of paperwork in front of you. Your hand is probably cramping from signing your name 1,000 times, and it's right in that moment, that mix of excitement and total overwhelm, that they slide this critical decision in front of you. And it is so easy to miss the details. All right, so let's start with that offer the bank puts right in your face. It's usually tucked right into that huge stack of closing documents, and they make it sound so incredibly simple. Like, hey, just check this one little box, and poof, your new home is protected. That offer is for something called mortgage protection insurance. And the way they present it, it seems like a complete no-brainer. The message is simple. If something happens to you, don't worry, your house is paid off. It sounds like the responsible thing to do, and let's be honest, in that moment, who wouldn't want one less thing to worry about? But hang on, what is this thing really? Let's kind of pull that single piece of paper out of the stack and put it under a microscope. What does mortgage protection insurance, or MPI as they call it, actually do? On the surface, it seems pretty straightforward. It's an insurance policy designed to do one and only one thing: pay off whatever you still owe on your mortgage if you die. It sounds simple, but, and this is a big but, the details are where everything changes. Okay, here's the fine print, the stuff that gets glossed over. Number one, and this is a big one, the money, the payout. It doesn't go to your family. Nope, it goes directly to your lender. Number two, as you faithfully pay down your mortgage every month, the amount of insurance coverage you have actually gets smaller and smaller. And number three, if you ever decide to sell your house or refinance your loan, that policy is tied to that specific mortgage. It very well might not move with you. So why do lenders push it so hard? Well, because it's a really simple product to sell right there at the closing table. But that simplicity comes at a cost for you. You're basically paying the same premium year after year for a benefit that is constantly shrinking in value. It really just solves the bank's problem, not necessarily your family's. So this brings us to a totally different way of thinking about this. An approach where the focus isn't on protecting the lender, but on protecting your loved ones and, most importantly, giving them options. Let's just reframe this whole thing. What if, instead of the money automatically paying off the bank, your family had the power to choose what to do? What if you were the one in the driver's seat? This is where term life insurance enters the picture. It's really straightforward. You get insurance coverage for a specific period of time, say 30 years, to match your mortgage. And here is the absolute game changer. You choose the beneficiary. The money goes to the people you want it to go to. Now let's look at how this creates a much better safety net. First off, your coverage amount doesn't shrink. It stays level for the entire term. The policy is also portable. It's yours. It goes with you if you move, if you refinance, whatever. And most importantly, your family gets a lump sum of cash to use however they need to. They can pay off the mortgage, sure, but they can also cover other bills or invest for the future. Plus, and this is a big one for a lot of people, it's often way more affordable if you're healthy. Okay, so we've looked at both of them on their own. Now let's put them side by side. This is where the differences become crystal clear. All right, let's put these two head to head on the features that actually matter to you, the homeowner. When you see it laid out like this, it's pretty stark. With MPI, who gets the money? Your lender. With life insurance, it's your chosen beneficiary, your family. What about the coverage amount? MPI's decreases. Life insurance stays level. How can the money be used? MPI is for the mortgage only. That's it. Life insurance can be used for absolutely anything. And finally, portability. MPI is stuck to that one mortgage. Life insurance, it stays with you no matter what. So here's the absolute bottom line. When you strip away all the jargon, it's this simple. Mortgage protection insurance protects your bank. A term life insurance policy protects your family. At the end of the day, this decision isn't just about a house. It's about securing your family's entire future and making sure they have control during what would already be an incredibly difficult time. So let's just quickly recap the 3 key ways life insurance gives you control. 1. You decide who gets the money, which means your family has choices. 2. You get consistent value for what you pay because the coverage stays the same. And 3. Your protection isn't chained to one loan or one house. It's yours. And it is so important to remember this. Paying off the mortgage is a massive help, but it's almost never the only financial challenge a family is facing. You also have to think about replacing lost income, covering everyday bills, maybe paying for childcare. The list goes on. A life insurance policy provides a safety net that can solve the whole problem, not just the single debt the bank cares about. So as you're sitting there looking at all that paperwork for your new home, the question you really need to ask yourself isn't just about protecting a loan. It's about who you're truly protecting. Is it your bank's financial future or your family's? The choice you make answers that question.